All right. Today is Sunday, April 25th. This is a recap for the stock market activities last week and an outlook for the upcoming week. We have experienced choppy trading during this week, up one day, down the other, mostly being impacted by earnings and the news. And the most important piece of news we got this week was the announcement from the Biden administration regarding increasing capital gains taxes. Reacting to this news, the market on Thursday decided to sell off and reverse a rally, but that reversal was short-lived because the market on Friday reversed the reversal and once again shaking off the concerns regarding increasing capital gains taxes. The question is, does the market indeed believe that this is a negotiating tactic and capital gains taxes might not increase to the magnitude that was announced on Thursday, which is almost doubling the current rate? Now, regardless of the outcome, capital gains taxes will indeed increase, and therefore the biggest winners, the biggest earners, making millions and millions of dollars in capital gains because the market is up significantly year over year. Matter of fact, if you look at the map, pretty much every single name registered multi-year gains in a single year. And therefore, whether the rate rises to double the current rate or not, the point remains we will see a sell-off regarding capital gains because it would not make sense for these big winners with millions and millions of dollars of gains and let them ride further knowing that they will pay an extra rate of taxation. Furthermore, the market is heavily bloated with massive gains. It wouldn't make any sense for somebody who bought the stock market last year to sit on millions and millions and millions of dollars of gains, risking that these gains might disappear to begin with if the market reverses, since we are in a heavily bloated market with high valuations, and in addition, risking paying more taxes. And the question is, which side, which names in the market will be sold off more than others? I have all the information for you during the headlines of the day segment. In addition, I have stunning economic data regarding inflation, specifically in the housing market and in grocery store items. We will also discuss the price action in Bitcoin the last few days and cover the fact that we just saw the biggest outflow, once again, outflow from the NASDAQ since the dot-com bubble. What does that mean for the market? We will try to answer that question and a lot more. But before I start, here is a disclaimer. I do not initiate contact with any of my viewers or subscribers. So if you do receive contact claiming to be me, you are probably getting spammed. Furthermore, when I do respond to your comments in the comment section, my response will be highlighted in gray, as you can see right here. Any response that doesn't look like this, it's not for me. So help me out, clean up the comment section here by reporting all of the impersonators and the crypto spammers, because we cannot ask YouTube for more help. After all, they're doing a lot for us already. Anyhow, let's start the coverage by reviewing the market's performance on Friday. And here we go. The Dow Industrial Average closing in the green by 227.59 points, or a gain of 0.67%. The NASDAQ closing in the green by 198.39 points, or a gain of 1.44%. The S&P 500 also closing in the green by 45.19 points, or a gain of 1.09%. Notice that the volume for the Dow and the S&P 500 is getting closer to normal, but the volume for the NASDAQ remains under the average. And this has been the case for the last few weeks, by the way, regarding the NASDAQ. However, this volume is about to be ramped up higher, and this is due to big tech earnings, which we will discuss in details during the conclusion of this video. What about the sector's performance? On Friday, leading the pack at number 1 in capturing the gold medal, materials, and number 2 for the silver, financials, and number 3 for the bronze, communication services. The only laggard on Friday was the utilities sector, closing slightly in the red. Yet all in all, pretty much every single sector of the market managed to close in the green. Now let's contrast that with the weekly picture for the sector's performance. Leading the pack at number 1 and capturing the gold medal, real estate; at number 2 for the silver, healthcare; at number 3 for the bronze, industrials. The laggards led by energy, utilities, and consumer cyclicals. Now, as you can see, Friday's session was pretty much every sector closing in the green. However, the weekly picture, we only had 2 sectors, real estate and healthcare, closing decisively in the green. Meanwhile, every other sector of the market has been already exhausted and bloated. And therefore, yes, we saw big days, big up days, big down days, but all in all, the picture was negative for these sectors, whether we're talking about energy, utilities, technology, all closing in the red. What about the advance to decline ratio on Friday for the New York Stock Exchange? 78% advancing versus 20% declining. What about the NASDAQ? 73% advancing versus 24% declining. All in all, a decisive day in the green for both the NYSE and the NASDAQ, pretty much reversing all of the losses from the previous session. What about the futures market? What's going on here? We saw declines in the US dollar throughout the week, and therefore this was a good week for commodities, specifically dollar-sensitive commodities like copper, grains, and crude oil. Speaking of, crude oil closing in the green on Friday. For both the WTI and crude oil Brent, about 1% gains apiece. What about softs? No stopping sign for lumber futures. To the moon. Another day, more gains for lumber. Likewise, we saw big gains for cotton futures, over 3% on Friday's session alone. We also have gains for coffee, about 2% or so. However, we saw muted activities for sugar, coca, and OJ. OJ is the only futures closing in the red in softs. What about metals? Muted activities for gold and silver. Gold and silver liking the downward action in the US dollar, but they're not liking the stability of yields, at least on Friday. Yet we saw gains for copper, platinum, and palladium. Copper is getting very close of reaching all-time highs. But hey, where is inflation, right? What about meats? Lean hogs, aka the new big tech, closing in the green with massive gains on Friday. Likewise, we saw a rebound for fetal cattle futures. However, live cattle futures were muted for the day. What about grains? We saw gains for corn, wheat, rough rice, and soybeans futures. But the action was muted for canola, soybean meal, and soybean oil futures. The only decliner, oats futures, even though oats futures have been on a tear as of late. We have a new IPO for Oatly, an oat milk producer backed by many celebrities. Moving on to the big casino, the options market, and let's see how the tables performed on Friday. Leading the pack at number 1, Apple, per usual, with about 1.5 million contracts. About 69% of those were calls. At number 2, Tesla, with about 900,000 contracts. About 57% of those were calls. Snapchat at number 3, with a little over 780,000 contracts. About 69% of those were calls. What about the unusual trades taking place in the options market on Friday? Let's start with the ticker VRTX for Vertex, and this is a big one. And they are making a bearish bet, by the way, very noticeable. Perhaps they know something about the name that we don't know, because they're buying the 195 puts, expiration date June 18th, with expectations that the name will decline over 10.5% by then. They paid $4 a piece to enter this trade, all in all bringing the total to about $9.6 million. What about the ticker SPY for the S&P 500? Also a bearish bet here. Perhaps protection by buying the 390 puts, expiration date June 4th, with expectations that the SPY will decline over 6.5% by then. They paid $2.70 a piece to enter this trade, all in all bringing the total to about $4 million. What about the trade for the ticker XLE for the energy ETF? They're making a bullish bet here for the energy sector by buying the 53 calls, expiration date July 16th, with expectations that the name will rise over 11.5% by then, and they paid about 95 cents a piece to enter this trade, all in all bringing the total to about $1.4 million. What about the trade for the ticker triple Qs for the NASDAQ? Here we have a bearish bet by buying the 261 puts, expiration date July 16th, with expectations that the NASDAQ will drop over 23%. This is a big one. 23% drop, and they were willing to pay $1.3 a piece, which brought the total all the way to about $1.3 million. The likelihood is that this trade is from someone who's up big since last year, and the majority of their holdings is in technology stocks, and they are buying protection in case the market crashes, and they are willing to tolerate about 23% losses from where we are trading right now, but nothing more than that. What about the trade for the ticker SYPR for Cyprus? And this name blasted higher, over 50% on Friday's session. And the reason is the company won a contract for the space program. And here we have somebody betting for more gains to come by buying the $5 calls, expiration date May 21st, with expectations that the name will rise an additional 12% or more by then, and they paid about $1 a piece to enter this trade. All in all, bringing the total to about $1 million. Moving on to the headlines that shaped the day, starting with macro news. If you thought that the housing bubble, the housing mania is over, think again, because it's gonna get hotter and hotter by the day. We received information on Friday regarding housing prices and inventory. Here it is. New home sales rebound to a 15-year high in March. The Commerce Department reported sales of newly built homes surged 20.7% last month to a seasonally adjusted rate of 1.02 million units. That sharply beat economists' expectations for sales to rise to a pace of 886,000 units. And this is the fastest rate of increase since 2006. This is exactly what I predicted, by the way. The increase of interest rates, mortgage rates, due to the increase of the 10-year Treasury yield, will only add a mini pause to the housing mania, because buyers will soon realize that perhaps rates already bottomed and they're not going to get a better offer than what they're getting right now, because as they're waiting for rates to drop again, the houses they're eyeing are being sold, and therefore there is this FOMO that perhaps rates are not going to go any lower, and you got to buy now regardless of the price, because rates are going to continue to rise higher, and perhaps prices will also continue to rise higher due to the shortage of supply. And this is exactly what we're seeing right now. A rebound from the mini pause when we saw interest rates rising earlier this year. So the housing mania has a lot more. The housing bubble has a lot more to go. New home sales surged 66.8% compared to March of 2020. There were 307,000 new homes on the market in March, marking a 3.6-month supply at the current sales pace. The median new house price rose 0.8% year over year to $330,800. So the supply is ramping up, but it is way behind the demand. This is exactly what we talked about a few videos ago, that the gap between supply and demand is huge. And even if you ramp up the supply chain and you build more houses, that's going to take more time, and the demand is not slowing. We have more stimulus on the way, more stimulation from both the federal and the monetary side of the government. And the contrast could not be any clearer than this. Home prices, this is the median price, by the way, in blue, surging significantly higher. Meanwhile, the existing home sales inventory in orange, declining to the lowest level in decades. So once again, the gap between the supply and the demand is extremely wide, and that will continue to add to the inflationary pressure in home prices. And here is from Redfin. 45% of homes, once again, 45% of homes sold for more than their list price, an all-time high. Ladies and gentlemen, this is hysteria, the housing mania. Everybody's stampeding because you watch a house for a week or two, perhaps a month, you go back and forth with the broker waiting for a better deal, and all you know, the home gets snatched up by another buyer who's offering cash and above the listing price. So that will increase the FOMO factor psychologically, where consumers say, we gotta buy now. We gotta buy anything, because soon enough we're not gonna have any houses to look at, and rates will go higher. Prices will continue to go higher, and that is adding to the inflationary pressure. You see, inflation works pretty much via psychology. Whether the interest rates are going to remain high or low or stable, who cares? What matters is the psychology, and the stampede dictates where the prices go. And in this case, they're going higher for housing, and that is impacting lumber futures, new all-time highs every single day, and you are seeing home builder stocks outperforming significantly. But here is the risky side of what's going on in the housing mania. The difference between now and then in 2007, 2008, that there is less risk taking. However, the devil is still in the details. For example, the US mortgage equity withdrawal is reaching the highs prior to the housing market crash in 2008, meaning that households are juicing up the value of their homes by taking more risk and more loans. And the risk here is what happens if the bubble pops suddenly, because as in the stock market, in the housing market, we're also seeing the same phenomena of trusting the Federal Reserve, meaning trusting Jerome Powell to give us an advance notice before he starts tapering and raising interest rates, therefore popping the bubble. Now, you have to ask yourself a question. Are you that stupid? The market will react in advance before Jerome Powell even think about giving us a warning. The market will see it ahead of time because Wall Street insiders will get the news first. More in macro data pointing to higher inflation. And you have to remember, when we read these headlines, you have to ask yourself a question. Is this piece of news good for the economy? Is it a good economic news? And if it is, then it is bad for the stock market, because the better the news, the higher the inflation, the sooner tapering will take place. Here is an example. Data firm IHS Markit said its U.S. Services Index jumped to 63.1, up from 60.4 in March, the highest reading since data collection began in 2009, signaling the swiftest pace of expansion in at least 11 years. Once again, good news for the economy. It shows us that the economy is heating up significantly. But that also means that inflation will rise higher. And at these bloated valuations, the market is at risk. Here is another indicator for higher inflation: the manufacturing supplier delivery times. And we are at the highest reading. Ladies and gentlemen, pay attention. The highest reading, surpassing the highs of the great inflation in the 1970s. Matter of fact, this reading is the highest since 1951, meaning that manufacturers are waiting longer for supplies to arrive than any year since 1951. But hey, where is inflation, right? The deflationary forces, the supply chain. The only deflationary force out there is the market crash. If the market crashes, then inflation expectations and confidence plummets. The strongest deflationary force right now is a stock market crash, a housing market crash, a commodities market crash. Absent of that, inflation will get out of control and crash the market eventually. So you know what? Perhaps Jerome Powell is right about inflation being transitory. But what he's not telling you is that perhaps it will be transitory because they will crash the market. They will increase interest rates. They will taper the cocaine operation. And that perhaps will not just crash the market, by the way, but also slow down the economic recovery. Because the assumption is that once you heat up inflation to rise significantly, creating all of these jobs and increase in capital expenditures, that the market and the economy will be able to stand on its own feet without the Federal Reserve's help and support. That is perhaps a false narrative. In addition, this promise and false guarantee that by tapering, inflation will just go away. Meanwhile, we know from history that once you unlock inflation to rise significantly higher, it doesn't just go with a magic wand. It stays there. The impacts remain even after the forces that caused the inflation to happen to begin with are gone. More in macro data. Here is another headline, and ask yourself the question: is this good news for the economy or bad news? Economists surveyed by the Wall Street Journal project U.S. gross domestic product will grow 6.4% this year, while the economists expect employers to add 7.1 million jobs in the 12-month ending in December 2021, a gain of 5%. And once again, the biggest argument from the deflationary camp and this is, by the way, the educated deflationary camp, is that yes, inflation will rise higher, but once you take the stimulus out, the deflationary forces will take place. That is an assumption, and it could indeed be wrong, because historically speaking, once again, unleashing inflation lasts even after the factors that unleashed the inflation to begin with are gone. And by the way, in that case, if the economy does not stand on its feet by maintaining the jobs it will gain this year, then that will open the door for the stagflation phenomena. There are so many assumptions here of how this movie will end, but we all know that the ending will not be good. And so far, the inflation indicator that the Federal Reserve uses is the core CPI, aka the CPI. We know that the CPI is a lagging indicator and furthermore easily manipulated to distort the facts. For example, a few days ago, I showed you the correlation between the Empire State Manufacturing Index and the core CPI. It is almost a perfect correlation, meaning the Empire State Manufacturing Index has reached multi-year highs. Meanwhile, core CPI remains lagging for some reason. Here is another indicator that shows almost a perfect correlation between the non-farm unit labor cost and the core CPI. The non-farm unit labor cost has reached the highest reading since the 1990s, meaning that core CPI should be following the same relationship, and it will rise significantly higher in the next coming month, regardless of the manipulation. And here is how inflation is impacting corporate earnings. 45% of all companies' earnings reports discuss inflation. Many of them are stating they will be raising prices, like Procter & Gamble. 45% of the companies reported so far talked about inflation and the negative impact of the inflationary outlook. But hey, where is inflation? We're not talking about something that is coming. We're talking about something that's already here. Yet market participants continue to ignore the facts, and they continue to take more and more risk. We talked about copper prices reaching all-time highs. That will happen very soon. The metal is in demand as the world comes roaring back from the pandemic. And that means people want things again, from cars to homes to phones. The skill is for you to find out companies that are able to pass the extra input cost easily to the end customer. And in this case, we have two names that I've been touting since before the beginning of the year. Freeport-McMoRan, the ticker FCX. This is the largest copper producer in the world, and they have a lot of pricing power. They will just add and pass the extra cost to the buyer. Likewise, big contractors, the likes of Hubble, for example, will be able to pass the extra cost to the end customer. And therefore, inflation is actually good for this side of the market for names like Hubble, the ticker HUBB. But inflation is bad for companies that cannot pass the extra cost and will have to squeeze their margins. Therefore, this earnings season could not be any more important. And here it is, inflation is starting to hit households directly in the goods they consume every single day. And now we're seeing diaper inflation, not because babies are shitting their pants, but because the prices of diapers are going higher. Diapers are pricey, essential item for parents. Now they're getting even more expensive, hurting low-income families already struggling with the pandemic's economic woes. You hear that, Mr. Jerome Powell? Inflation is not going to help the poor. Inflation will only help the rich by inflating asset prices higher, creating a massive bubble that will crash on the top of the heads of everybody. But the poor and the middle class will suffer the most. Here is an example. Low-income families will struggle with paying more for diaper prices. And here is another supporting fact that inflation will rise even hotter than many expect, specifically the Federal Reserve. Wages will continue to inflate as well. Perhaps not to the same rate as real inflation, but wages will go higher. For once, the minimum wage proposals and also companies paying more to attract the talent because there is a shortage of quote-unquote skilled workers or available workers immediately, since we have all the stimmies and the programs keeping people to stay at home rather than looking for a job. But the sentiment overall has changed. because Americans now, the overwhelming majority of Americans, indeed support higher minimum wage, specifically the $15 federal minimum wage. And by the way, here is another disclaimer, because I made a video last time and people perceived it as a criticism for the Biden administration. We don't play the Team Red, Team Blue bullshit in this channel. We expose the facts as they are, regardless of any biases. Now, personally, I am a supporter of the minimum wage, but I do support increasing the minimum wage based on each jurisdiction. For example, a $15 minimum wage in Jackson, Mississippi doesn't make sense as it does in LA, California. Two different worlds here, and they shouldn't be treated the same. Furthermore, in general, I am supportive of increasing the capital gains taxes on the rich because they had it good for a long time. It is time for the rich to pay their tab for the country. But I am being candid and honest with you that increasing capital gains taxes will impact the stock market negatively. I cannot sugarcoat the facts for you. Likewise, increasing the minimum wage and creating wage inflation will impact the market negatively because corporate earnings will get squeezed by extra labor cost. I cannot sugarcoat the facts for you. Here is more regarding this invisible phenomena we call inflation. It is now starting to hit consumers' pockets directly in grocery store items. The grocery price shock is coming to a store near you. A key measure of farming commodities has surged in recent years. This week, the Bloomberg Agricultural Spot Index, which tracks key farm products, surged the most in almost 9 years, driven by a rally in crop futures, with global food prices already at the highest since mid-2014. This latest jump is being closely watched because staple crops are a ubiquitous influence on grocery shelves, from bread to pizza dough to meat and even soda. Oh no, don't you dare come for my pizza dough. Housing inflation, I'm okay with that. Used car inflation, I'm okay with that. Diapers prices, I don't care about that at all. But when it comes to pizza dough prices, keep your hands off my pizza. Soaring raw material prices have broad repercussions for households and businesses and threaten a world economy trying to recover from the damage of the coronavirus pandemic. They help fuel food inflation, bringing more pain for families that are already grappling with financial pressure from the loss of jobs or incomes. For central banks, the geniuses that they are, a spike in prices at a time of weak growth creates an unwelcome policy choice and could limit their ability to loosen policy. And when American households are asked, how concerned are you about increased costs of household expenses? 46% said very concerned and 41% said somewhat concerned, meaning that the overwhelming majority of Americans are indeed worried about inflation. And remember, inflation is also a psychological phenomenon. If all of us expect higher inflation to come, we will start spending now and therefore fueling inflation to rise even higher. And this is, by the way, what the Federal Reserve wanted to begin with. So they're getting what they asked for last year. Yet they want to have their cake and eat it too. Now that they're getting what they want, all of a sudden they want to distort the facts and manipulate them by censoring and more propaganda because the inflation risen higher past their expectations earlier than they expected. They want everything to be timed under their control. It doesn't work this way. And more in macro news, let's talk about the capital gains taxes. Biden proposed doubling the capital gains taxes and the market decided to freak out. However, as the market started to process the information, it decided to shake it off because the slim possibility that this proposal will pass. Number one, we have Joe Manchin of West Virginia now throwing cold water that he will support this bill of increasing capital gains taxes to double the current rate. Remember, the Democrat Party, as the Republican Party, owned and controlled by donors, by the billionaires and the 1%. They're going to support all of the spending, infrastructure, climate change, racial inequality, save the donkeys. It doesn't matter. They're going to support every proposal so long as the money is not coming from their pockets, so long as the money is being printed out of thin air and racked up for the next generation, or it is coming from the pockets of the poor and the middle class. But when the proposal goes as far as asking them to pay more, that's a no-go. No, 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 no. Don't come for our pockets. That wasn't the deal, Mr. Biden. We didn't put you in office to tax us more. And therefore, the market is brushing this off right now. However, even if capital gains taxes are not hiked up all the way to double the current rate, they will indeed go higher. And the expectations are for now that they will go all the way in the 30s level from the current 20% all the way to 30, 32, 35 at the most. That is still a significant increase in capital gains taxes, and it will indeed cause a sell-off. Doesn't mean that it will cause a market crash, but it will cause a sell-off to lock in these low capital gains rates. And that leads us to market sentiment news, starting with this report from Goldman Sachs. The last time capital gains taxes were hiked in 2013, the wealthiest households sold 1% of their equity assets, the Goldman analyst found. 1% is not a big deal, meaning it will not be persistent, it will not be the factor that would crash the market, but indeed it will be a big sell-off, nothing to sneeze on. Get ready for $178 billion of selling ahead of the capital gains tax hike. These are the stocks most at risk, and this is from Market Watch. They're basically looking at the stocks that risen the most since last year, and also the names that risen the most in the last 5 years since the last increase in capital gains taxes, because these are the names with the majority of gains. They become the natural ATMs to pull cash from. And here are some of these names. We have Penn National, the year-over-year gain exceeding 575%, L Brands, Caesars, Tesla, Gap, Freeport-McMoRan, Enphase Energy, Tapestry, Etsy, Generac, Moderna. All of these names are big year-over-year. So if you made millions of dollars trading and investing in these names, it will make sense to pull the trigger and cash in the gains before the rate goes higher, specifically if corporate earnings for these names are not so pristine. And this is a very important point to pay attention to. They perhaps will wait to corporate earnings, but if the earnings of these names are not coming out excellent, meaning that the stock will continue to rise significantly and impulsively higher the next few weeks to the next few months, then they will pull the trigger right now. So keep this list and watch it carefully. Watch these names and the reaction after earnings. Now, what are the stocks that are up the most since the last hike? Here is the list. More tickers for you. Enphase Energy, the ticker ENPH, Etsy, and these names, by the way, ENPH up over 6,000% a year. Not a year, but 5 years change. Etsy, the 5 years growth is exceeding 2,000%. And then we have Nvidia, AMD, Tesla, all of these names that went up the most the last 5 years will be the ones that cash will come out of. And the strategy is here. If you own any of these names, and I do own some of these names, it is worth it to pull out some profits, specifically if you made over $1 million in gains. But if you did not make over $1 million and you would like to continue to hold the name in your portfolio, it would make sense for you to buy some puts in case earnings disappoint and we see a massive sell-off in some of these names. Buying puts as an insurance policy. More in sentiment news. And here we have another reliable indicator showing us that the market is at very dangerous territory. We have the margin debt versus the S&P 500. And every time we see margin debt rate rolling over, that is an indicator that the mania is coming to an end. That happened before in the crashes of 2008 and the dot-com bubble bust. We're seeing the same formation happening again in this current bubble of 2020-2021. The level of margin debt is the highest since 2008, but it is rolling over, and that is an important indicator for those who are paying attention. Here is another indicator, the trailing price to earnings ratio for US stocks. We are at the highest levels since the dot-com bubble. Matter of fact, we are pretty much equal to the highs of the dot-com bubble. Every time the market reached such high, elevated readings, we saw a market crash, going all the way back to the 1920s. But here is perhaps the most stunning piece of data I have for you tonight. The outflow from the NASDAQ, the triple Qs. We have witnessed the largest outflow out of the Qs, the NASDAQ, since the dot-com bubble in the year 2000. And the question is, why are we seeing such a large outflow out of big cap technology stocks and the triple Qs just before the biggest technology names report earnings. This is a critical indicator regarding the sentiment of the market right now. And this is not the only dumping going on by insiders, whether we're talking about corporate insiders or companies issuing more bonds and more shares to milk this mania for all of its worth, because they know that this is too good to be true and they have to juice it up to their benefit. The lowest rated US companies are selling bonds at an accelerating pace, with this month issuance of more than 38 billion, already setting a new record for April. And this is, by the way, the lowest rated, meaning the piece of shit junk bonds from garbage companies, and the issuance at all-time highs. What does that tell you about the sentiment? They want to dump and raise as much cash as they can before the party's over. But the party's not over, at least not for now. It is actually getting crazier and more deranged by the day. For example, we're now chasing virtual assets that don't even exist. Ether Rock allows you to collect and trade virtual rocks built entirely on the Ethereum blockchain with a decentralized smart contract. Only 100 rocks will ever be available, and each new virgin rock gets more and more expensive. This is like playing Pokemon with real money. I mean, the level of stupidity and absurdity is extreme. If you thought that was crazy, here it is. We have a TikTokers who made a new coin called Scam Coin as a joke. And within an hour, Scam Coin has risen in value to be worth over $70 million. But I know Scam Coin is the future, bro. Look at me with a straight face. If you are the bulls of bulls, look at me with a straight face and tell me that this is not an insane, absurd, unsustainable orgy that will not last. And I know what you're gonna say, but play the game, bro, until it's over. The trend is your friend. Papa Jerome is gonna let us know when the party's over. Good luck. And by the way, if you thought Scam Coin was absurd, I'll give you 3 seconds to take the kids out of the room, because here it is. We now have Come Rocket Coin. Come Rocket Coin surges 634% in a single day as market cap breaks $140 million. What the is going on? We're now making actual jokes. You know, you thought Dogecoin was absurd. Dogecoin looks like a real asset compared to this garbage. Scam Coin, Come Rocket, and what's next? This is an absolute extreme absurd mania, the craziest bubble of all time. There is nothing even close. We brought the .com bubble to shame. We have a deli, a sandwich shop over in New Jersey that is worth $100 million. And we know that that was a front for a money laundering operation, by the way. We'll talk about that later. But speaking of Come Rocket, he was model Emily, whatever that is. And of course, guys are into this chick. I don't know why, at least a few years ago. They were going crazy about her. I don't understand the appeal, but hey, if starvation turns you on, then have at it. And perhaps soon enough, you will be able to buy a used pair of panties from Emily as an NFT using your Come Rocket. But what about the king of the mania, the 21st century's tulip mania of Bitcoin? Because Bitcoin lost over $260 billion of its value the last few days. But I know this is the replacement for the worthless fiat currency and gold and all of that. How do people live with the stress, by the way? You gotta stay up all night because this is traded pretty much 24/7. And what do you know? You wake up and Bitcoin is down 20-30%. Dogecoin is down 20-25%. What is the appeal of this kind of investment? When you are under high stress, frozen in front of the computer screen, refreshing the page, looking at the price action. What is the appeal of this kind of quote-unquote investment? When you can invest in stocks of solid companies with good balance sheets, good earnings, decent valuations, decent growth. Yes, valuation's very hard to find, but you're better off buying anything right now beside this garbage. And here we have the Black Swan author, and he's describing Bitcoin as a Ponzi scheme. And something very interesting happened last week in Turkey regarding the cryptocurrency market. Turkish crypto exchange boss goes missing, reportedly taking $2 billion of investors' funds with him. And in response, the Turkish police arrested 62 people after one of the nation's major crypto exchanges stopped paying clients and its founder fled the country. Now, Turkey is facing high inflation and their currency, the Turkish lira, is in the dumps, and therefore the appeal, the sexiness of cryptocurrencies as a store of value, and therefore a lot of Turkish people, investors, decided to trust this scammer with about $2 billion worth of assets to be invested in cryptocurrencies. Now the man has fled with the money and investors lost it all. And you see the crypto scams and spammers in the comments on Twitter and every YouTube channel. Tell me again how sound and healthy an investment in Bitcoin is. It's a wild, unregulated jungle. And yes, I say that about the market too. A wild, unregulated jungle. But we have the SEC regulating the market, at least on paper. Who is there to regulate the crypto market? Decentralized? Give me a break. As we hear more stories like this, and we see huge price fluctuations in Bitcoin and other cryptocurrencies prices, regulations must come. And when regulations come, investing in cryptocurrencies will not be as exciting as it is right now. Prices will stabilize, but perhaps will crash first due to the regulation sell-off and then stabilize a lot lower. Perhaps then investing in cryptocurrencies will be attractive. Not right now, at least not for this guy. And by the way, all of these reckless decisions by quote-unquote investors, specifically the new generation of investors. You know, the kind of guys who follow influencers on TikTok and YouTube for investment advice. They are in a world of pain. Matter of fact, they're losing interest in the market overall because they are stuck in a handful of names that are down big from the highs. They've been chasing the mania. Some of these names are down 50, 60%. And they're talking about the market being difficult and the market is in a crisis. Meanwhile, the S&P 500 is at all-time highs. Take a look at the 3-month performance for the stock market. Pretty much every single thing is lighting up green, exception some of the mania names. And they happen to be stuck in these mania names. And therefore, we have the contrast of two markets. The market that continues to go higher every single day, and then the market that remains very challenging and very frustrating for those stuck in it. We're done with sentiment news. We're moving on to corporate-specific news, starting, you guessed it, Tesla, the souffle. The souffle is now under pressure from politicians. Left and right, by the way. Tesla is being scrutinized by Senate Democrats for autopilot misuse. And here we have Jim Farley of Ford, the CEO of Ford, trolling the culties by retweeting the fact that Consumer Reports were able to prove that Tesla vehicles, the FSD program, can indeed take over the vehicle with nobody on the driver's seat. Of course, that triggered the culties, and the comments, the responses from the culties are absolutely hilarious. What about the tension between the souffle and China? Despite all the apologies and the ass-kissing from Reverend Elon Musk and Tesla, China is not pleased. Tesla is branded as quote-unquote arrogant in China as pressure mounts on the electric car maker. And now we're seeing videos on social media surfacing showing that the Chinese authorities are not letting Tesla vehicles drive on highways. Furthermore, the souffle is already waving the white flag by increasing prices for the Model 3 and the Model Y again. And now the starting price for souffles start at $39,000. That is significantly higher from Chinese manufacturers, the likes of NIO, Xpeng, Li Auto, etc. What does that mean? It means that Tesla is in trouble. They're waving the white flag. Matter of fact, the prices for the Model 3 and Model Y have gone up over $2,000 since earlier this year. What does that mean for the souffle's earnings? Because we have earnings on Monday. Perhaps this will be good news in the short term. Why is that? Because the company has been criticized as non-profitable. They don't make profits by selling cars. They make profits by selling regulatory credits to other companies. That practice will end soon because other companies are also entering the EV arena. So Tesla's only option right now is to hike up prices, and the consumers of Tesla will pay more. Therefore, perhaps we could see this quarter being the first profitable quarter for Tesla, excluding regulatory credits, and that would be good news for the souffle short term, and you could see the shares rallying impulsively higher. The problem is that the long-term challenges remain on the table. by hiking up prices, Tesla becomes less and less competitive, and it will continue to lose market share. So the market reaction after earnings, assuming, that's an assumption of course, that we will see the first profitable quarter for Tesla buy-selling vehicles. The reaction will be very important. Will investors reward the fact that Tesla is profitable by hiking up prices, or will they see this as a negative factor that Tesla is losing competitive advantage and market share? And here we have the latest entry into the EV wars by Honda. Finally, Honda is announcing that they will shift their production entirely to EVs by 2040. But once again, Honda is lagging behind GM, Ford, even Toyota. They're not announcing any major EV development. What about Peloton? Here we have the LA Times questioning the officials' response regarding Peloton because they won't recall the treadmill that killed a child. Why aren't officials acting? I'll tell you why. Because our quote-unquote officials are now also busy gambling in the casino, in the options market. And I bet that they have a ton of Peloton calls. We know Nancy Pelosi has calls on Tesla and Microsoft, buying calls on Microsoft before the announcement of the Pentagon contract. Insider trading, classic, yet no consequences whatsoever. Our politicians are busy gambling in the options market rather than regulating. What about Apple, the iMob? The iMob will start enforcing the iPhone privacy change that Facebook is worried about next week, turning up the heat between the Apple versus Facebook war. And my question to Zucchiniberg is, try this. Cancel Instagram, shut it off from the Apple platform for 1 day, just 1 day. And all of these influencers will start to lose their booties and turn against Apple. You try to log on Instagram and you see a page saying, sorry, the app is not available on the iPhone platform because Apple is doing this and that. You will turn Apple users against the company. Very risky, but it is worth it because the iMob are not playing games anymore. And it is Zucchiniberg's turn to respond. Lastly, in corporate news, what about Cody? We've been talking about Cody for a while now as one of my favorite picks in the reopening names because it is still lagging the recovery and perhaps one of the few value names left in the market. Here we have some positive news for Cody. Cody is focusing on launching Kim Kardashian's skincare line, repackaging CoverGirl and consumer spending in China. There you go, the Kim K optimism. We should add another $10 billion to Cody's valuation because when Kim Kardashian is involved, inflation naturally follows. Moving on to the heat map analysis, and let's see what took place in the market this week. Obviously, we have some earnings reactions on the map. For example, Intel down big, over 8.5%. On the heels of earnings, we have Netflix down over 7.5%. We also have a name like Peloton, for example, down over 13%. Peloton did not report earnings, but we are aware with the struggles regarding the controversy from the treadmill. We also saw another theme of the mania names, the high multiple names, kind of outperforming this week. For example, NIO is closing with gains about 14% for the week. Likewise, Palantir also closing with gains of over 4% this week. And we have other names in the mania stocks, the likes of Plug Power, Blink Charging, also closing with some gains this week. All in all, there isn't a clear theme from the market action this week. It was all over the place, slightly tilted to the negative side, with an exception of the healthcare and real estate sectors catching up from behind. The rest of the sectors in the market are exhausted, and therefore, if anything, you're seeing some profit taking starting to take place. What about the themes of the market, starting with the reopening trade, the weekly performance? Mixed picture, but mostly in the green. We have certain names like American Express, reported earnings, and it was down significantly after earnings. We have more earnings to come for names like Hilton and TG Maxx, Royal Caribbean, Disney to come. Now, the names in the reopening trade that are already trading above the pre-pandemic highs will be at the most risk. You saw the reaction for AXP, and you will see more reactions like this, specifically if the outlooks are not as good, because we already know that the stimmies will speed up corporate earnings for the first quarter. But what about the outlook for the rest of the reopening? And if these stock prices are already pricing in the good outlook, then you will see pullbacks in these names. What about the inflationary trade? Negative picture overall, Again, these are some of the hottest performers year to date, and that makes them prime suspects for profit taking. These earnings better be really good because some of the names are up significantly. We're talking over double digits year to date. We're not talking year over year to date. So once again, if the market decides that earnings and the outlook is already priced in, we could see a pullback in these names. And the pullback will be an opportunity to buy because the macroeconomic conditions and outlook remains favorable for these names. The fiscal spending is not over yet. It is just starting, and that will act as a tailwind for these names. What about the disinflationary trade, specifically the high multiple mania names? Not a good week overall, by the way. Even though you saw certain names that have been beaten down severely the last few weeks rebounding this week. But the overall picture remains negative, and you see some of these high multiple names pulling back after earnings and in anticipation of earnings. We saw big losses for Nvidia, Shopify, Square, DocuSign, and the biggest loser is Peloton. The name is highly inflated, and perhaps all the good news are already priced in. And by the way, I receive a lot of questions regarding this list. Why is D.R. Horton and General Motors, American Airlines are included in the disinflationary names even though the multiples for these names are not really as high as the mania names? The answer is some of these names will start to suffer under high inflation down the road, not immediately. The first stage of market reaction regarding increasing inflation is to cut the high multiple names first. And as inflation persists and continues to increase higher and higher, that will start to impact corporate earnings. Thrive under low inflation because that reduces the input cost and therefore they are able to serve their value proposition of lower prices. But if inflation continues to rise higher and the input cost continues to rise higher, they will have no choice but to pass the extra cost to the end customer and lose competitive advantage. Or they have to eat up the cost, maintain the competitive advantage, but that will shrink their margins. Likewise, names like American Airlines and the rest of the airline sector, by the way, they're catching the tailwind of the reopening trade. But down the line, if inflation continues to rise higher, oil prices will also rise, and that will be a headwind against airline companies. Likewise, for home builders, in this case we have D.R. Horton, the rise of interest rates eventually will pop the housing bubble, and therefore a name like this will appreciate significantly in the beginning stages of inflation, but it will suffer tremendously during the later stages. What about General Motors, for example? This is a value name, it remains a value name even after the impressive run as of late. However, and that is true for every car and automotive manufacturer, as input prices continue to rise higher, their ability to pass the extra cost to the end customer is very limited because they lose their competitive advantage by increasing those extra costs. Because the necessity of cars, for example, from a day-to-day perspective regarding household spending is a lot smaller than, say, diapers. The inflation of diapers can be passed to the end customer from Procter & Gamble because the customer has no choice but to pay the extra cost. If General Motors increases the pricing for their vehicles, there is a limit to where the consumer can absorb the extra cost. So I hope that I clarified any confusion regarding the names on this list. Moving on to the charts analysis, starting with the 30 minutes chart of the SPY. We talked about the cup and handle formation on Wednesday, that this formation is supposed to guide us higher. And indeed we did trade higher all the way until Joe Biden decided to interrupt the party by announcing the capital gains taxes hikes. And you saw the sharp pullback, but the market decided to brush it off, shake it off, all the concerns regarding capital gains increases, and continued to march higher. 180 right away, and now we have a double bottom formation. We're trading pretty much at all-time highs. We have the resistance of 417.30. The market did not close above that level. We're not going to make a big deal out of it. The last candle of the day was bearish, but again, you're trading almost at all-time highs. You have the double bottom formation. The bulls have the advantage here in the short term for the SPY. What about the daily perspective of the continuous contract of the S&P 500? We're giving a thumb down here for the daily chart, and the reason is the chart is very extended from an RSI perspective, from a MACD perspective. We're about to make a negative crossing and start to lose momentum. as the volume starts to rise higher. And therefore, even though the formation is bullish, for all you know, this is a bull flag formation that is going to play to the upside. But the move is very, very extended and due for a correction. Therefore, the risk versus reward, whether to hop in the ride right now or to wait for a pullback, is on the side of waiting for the pullback, specifically knowing that we are heading for the most important week of corporate earnings. What is the destination for the correction? We have a gap that we left open, and that is highlighted in the yellow circle. We also have the very important level of support at 3,960. If we see a massive pullback, a big correction, 5% or so, that could take us all the way to 3,960 and then take it from there. The risk is if the market continues to rise higher, making the extension even more dangerous heading into earnings. What about the Qs? 30 minutes chart. Similar story here. We had the reverse head and shoulder formation that was playing to the upside. We had the interruption from the capital gains taxes announcement. The market flushed down, yet immediately reversing course, doing a 180 and continuing on the bullish trend higher. We do have an important resistance level at around 340, and the market managed to close below that level. Now, this week will be judgment week for corporate earnings for the biggest names in the Qs. We talked about the historic outflow out of the Qs. So once again, the chart from a 30 minutes perspective remains bullish. But what is the risk versus reward? To do that, we're switching to a daily chart of the continuous contract for the Qs. Similar story with the SPY. The market is trading pretty much at all-time highs, going back and forth around the level of 13,900 as I predicted. This is not an easy level, and you should spend a lot of time battling the level, gathering energy, and then blasting higher. And if that energy never shows up, then you have to go down, re-tag a lower level of support and find the energy there. If you don't find it at the lower level, you have to go further down. This is how typical charting behavior works. So we have 13,599. If that's not enough, we could go down all the way to 13,300, specifically if corporate earnings disappoint. We have an imminent crossing in the MACD indicator to the negative side, and we have a negative divergence in the RSI. So that is notable. The chart, if you remove all the context, it is looking bullish. However, measuring the risk versus reward, buying the market at these levels is extremely risky. What about the IWM? Small caps, 30 minutes chart. We talked about the level of 223 as the next resistance. We've beaten the resistance, trading higher. The sky is the limit. And then came the Biden tax sell-off, flushing down, closing below 223, followed by the 180, and here we are again above 223. We have a massive flush down during the last 30 minutes of trading. We're not going to make a big deal out of it right now, but it is showing that the resistance is increasing in or around that level. And we saw previous pullbacks from the same level around 225, 226. So that will be a sticky level for the IWM to pass above. Perhaps it needs to go down all the way once again to 223, tag some support, and then blast higher once again. But remember, a lot of the reopening names are going to report this week. And if the earnings come out disappointing, then that will add downward pressure on the IWM. The expectations are extremely high for these names. For more clarity, or perhaps lack thereof, we're switching to the RUT, the daily chart of the Russell 2000. We talked about the level of 2,264. The RUT must close, weekly closing, above 2,264 to keep any hope alive. We closed at 2,271. So the RUT for now did the deed, keeping the bullish outlook on the table. We are slightly fixing the negative divergence on the RSI. We don't have a definitive crossing in the MACD, and therefore watching this chart is extremely thrilling. It has been going back and forth for almost 3 weeks now, keeping us all guessing. What are investors waiting for to make the next move? Impulsive move, I might add, up or down. We're waiting for corporate earnings. Once again, what is the risk versus reward here? The expectations are very high. The valuations are very bloated. The risk versus reward says you're better off taking some profits or at least buying some puts if you have any that are included in the Russell 2000 as a protection. What about the dollar index? Bad week for the dollar. Massive slide down, breaking the support of 91. The dollar will reach an oversold point perhaps when it goes all the way to 90. But in any case, the dollar's rebound will happen hand in hand with a market sell-off and a rush to raise cash. Could it be that this week will be a good week for the US dollar if we see a sell-off in reaction to earnings? That is the question. But for now, the technicals are extremely bearish. What about gold? Gold is facing the resistance of 1800. And remember, this is a soft resistance, not a strong one. The strong one will come at 1825. Now, here's the interesting take. Weekly chart of gold. We had that massive decline, massive negative trend going all the way back since last summer. The question is, are we about to see a reversal in gold and a start of a positive trend? This is at least what the MACD indicator is signaling. We have an imminent crossing about to happen to the positive territory, creating green impressions on the histogram. And the ultimate test will be passing the level of 1,825. Closing above that level from a weekly perspective will confirm that gold prices will rally higher, and hear this, perhaps all the way to all-time highs once again. What about Bitcoin? A different story. Remember, gold has three enemies: the US dollar, yields, and Bitcoin. The dollar is shot up already. Yields have been static. They're not rallying impulsively higher as we saw earlier this year. They will at some point, but perhaps not in the immediate horizon. The third enemy for gold is Bitcoin. Bitcoin is also getting shot up, massive declines throughout the week. And we spotted the weakness due to the negative divergence in the RSI and breaking the trend of higher highs and higher lows. Furthermore, we had a confirmation from the MACD indicator of the negative momentum by crossing the negative territory, creating red impressions on the histogram. Furthermore, the chart failed to climb the yellow trend line, and that was the nail in the coffin right there to go short Bitcoin, or at least take some profits if you own some. The center of gravity remains 42,000, but you have to keep in mind that the chart will reach oversold conditions in the RSI at some point, and we will see a big rebound when that happens. Yet the long-term perspective has turned bearish. Why do we say that? Because look at the massive bullish trend starting all the way back to last summer. Matter of fact, to the bottom in March 2020. We've been in this massive bullish trend, and now the MACD indicator, the momentum indicator, is curling downward, registering red impressions in the histogram from a weekly perspective. Not definitive yet, but if we see another week of declines, then the pain just started in Bitcoin, and we will see a massive drop from the highs, perhaps to the tune of 50%. There will be ups and downs because you have a daily chart to look at, but the weekly chart, the big picture, is turning bearish. Here's another indicator for Bitcoin in Riot blockchain. This name has been consolidating in a wedge formation for weeks and weeks and weeks, and it has finally broken the consolidation to the downside. Riot has been a good indicator with great correlation with the trading in Bitcoin. Riot blockchain is saying that the chart has turned bearish and broken down, and that is pretty much the end of the bull run that started last year. What about yields? Yields are stabilizing, creating a triple bottom formation. Not a significant one. This is a 2 hours chart, but the market likes the stable action in yields. We have a positive divergence in the RSI, signaling a pickup in momentum that perhaps will take us all the way to 1.6% again. But we have conflicting information. I'm not trying to confuse you. I'm just trying to present all the facts for you clearly. It looks that yields are bottoming and they're ready to pick up a little higher. Perhaps not to the same magnitude, not the same steam it has been gathering earlier this year. However, when we switch to the TLT bond prices, from a weekly perspective, what does this look like? It looks like a negative trend about to turn positive with the imminent crossing in the MACD indicator. We know that yields and the TLT cannot rally together. One of these two is telling the truth. One of these two will rally impulsively higher in the next few weeks, and the other will decline. Now, if we are trusting the action in the TLT and the technicals, that the TLT is the one that is about to blast higher. What does that mean if we read the tea leaves? Combine that with yields going lower, combine that with Bitcoin trending lower, combine that with gold starting to turn positive. If I'm reading the tea leaves correctly, it is saying that we're about to see a sell-off in the stock market. Doesn't matter which sector. It could be technology, it could be the inflationary side, it could be both. And the money will go into buying bonds. pushing the TLT higher and pushing yields lower, perhaps all the way to 1.5%. I'm not making a prediction. We don't have a confirmation yet from a technical perspective. I am just reading the tea leaves. And where will the pullback come from, by the way? Is it going to come from the mania names first, the names that are down already 50%, 60%, or is it going to come from the value names that have been riding high since the beginning of the year? Take a look at the VTV, the value ETF, massive bullish trend since the March bottom, but it started to accelerate right after the outcome of the elections last November. At some point, the VTV has to get exhausted. We are reading extreme readings on the RSI and the MACD indicators. We need a pullback. This is a good thing, not a bad thing. We need a pullback. We need a correction in the inflationary names and the value names, because that correction will be an opportunity to buy the dip. But we do need a correction. The risk versus reward here, and I hold a lot of value names in my portfolio, is on the side of risk, meaning you're better off buying some puts, anticipating a correction in these names, and perhaps using that to your advantage by selling puts in the names that you like but don't own yet. For example, let's say you like Alcoa. I'm just throwing a name out there. The name is highly bloated, yet you do like the macro outlook and you think it is still favorable for a name like Alcoa. You sell puts, and if the name indeed corrects and drops down below the strike price of your put, you end up getting paid to buy these shares. Furthermore, if we switch to the MTUM, the momentum indicator, is the upcoming correction likely to happen in the momentum side of the market or the value? The momentum side already had a correction the last couple of weeks. Yes, it is impulsively higher. It could pull back in empathy with any sell-off in the market, but will the pullback likely happen from the value side or the momentum side? Looking at the charts, it is likely to come from the value side, and that could push the TLT higher, yields lower. We could see the mania names like Palantir and Neo catching a bid, moving higher once again, exciting the retail crowd. Folks, once again, I'm not making a prediction. I'm just reading the tea leaves for you. The market overall is bloated, but the run in value is a little more extreme than the run in momentum, because momentum already had a mini correction the last couple of weeks. Yes, it reversed back too quickly. It deserves another haircut. I understand that, and perhaps we will get that on the heels of big cap technology earnings. The message is protect your portfolio. How do you protect your portfolio? You buy puts or you go long the VIX. Here is the VIX going back and forth, choppy trading action, yet again, knocking at the door of the 20 resistance. And eventually it will be able to crack above that level. Cracking above that level will ignite a rally in the VIX, because all of a sudden market participants will say, oh, the VIX is trading above 20 once again. Let's rush and buy some protection. That will shoot up the VIX higher, perhaps to surpass 25 and even 30. What about Apple? Apple had the bear flag formation playing to the downside right after the capital gains taxes announcement. That is quickly reversed on Friday's activities, 180, just like the Qs, the SPY, pretty much every other chart in the market. But it is facing the resistance of 135. The name ran really hot the last few weeks, and now it is plateauing. It is consolidating. We said that the bulk of the gains in Apple have been already made, meaning that for now the chart will consolidate in anticipation of earnings. We could see a slight sell-off before earnings to de-risk, and that would take us all the way down to 131. But again, Apple almost doubled year over year. So those earnings better live up to expectations. Otherwise, we're going to have a flush down, a significant one. Lastly, what about Tesla? What's going on here? Also consolidating, not doing anything prior to earnings, as we expected, by the way. Earnings will be announced right away after the bell on Monday. What is the strategy here if you are a Tesla shareholder and you would like to protect your shares? You got to sell a naked call, for example, the 800 call, and then you use the money to buy the 650 puts. All in all, the trade will cost you zero, nothing. You buy the insurance policy for free. The worst case scenario is if the stock blasts higher above 800, the options will be exercised and you will have to sell your shares for 800, still at a profit, assuming that you bought the shares below 800. So the worst case scenario is you're going to make money. But the actual worst case scenario, if the stock crashes below 650, then you are protected, and you got protected for free. You did not have to pay anything for the insurance policy. So if you are a Tesla shareholder, you have Monday's session to buy your insurance policy. You sell a call out of the money where you're comfortable of selling your own shares at that level. You use the money to buy a put. What is your risk tolerance? If the stock drops 5%, 10%, 15%, you buy the puts accordingly with the money you collected from selling the call. And therefore, you buy an insurance policy for nothing or even get paid to insure your shares, depending on how you're going to structure this particular trade. But the principle is very similar. Selling a call out of the money and buying an out of the money put. And the critical level here is 679. If for whatever reason the chart drops below 679, that will open the floodgates for massive declines to come in Tesla, perhaps making a lower low since the correction that started in February. The other level to watch for, if the opposite outcome takes place after earnings announcement and Tesla blasts higher, is 781.30. That will ignite a rally and some short covering, and perhaps Tesla will be able to recover the all-time highs. That's still a possibility, but again, the risk versus reward is the disappointment is likely to come to the downside due to the rise of input prices. And remember what Elon Musk says, if we cannot control margins and lower our prices to remain competitive with other manufacturers, then the stock will be crushed like a souffle. So perhaps Elon Musk is already announcing the fate of Tesla stock. Moving on to the conclusion of this video, what do we have on the economic calendar for this week? On Monday, we have durable goods. On Tuesday, we have the Consumer Confidence Index. Wednesday, we have Federal Jerome speaking again. And then Thursday, we have, per usual, the initial jobless claims for the week and pending home sales. That will be very important regarding the housing mania, the housing bubble. Friday, we have the Employment Cost Index, which is a very important indicator for inflation. We also have the personal income, consumer spending, and core inflation itself. So this week was a muted week regarding the macroeconomic news. This upcoming week will be extremely rich. We also have earnings. On Monday, we have Tesla. Tuesday, we have 3M, General Electric, Microsoft, Google, and Visa. Wednesday, we have Boeing, UPS, Ford, Apple, Facebook, and Qualcomm. Thursday, we have Caterpillar, Comcast, Merck, McDonald's, Amazon. Friday, we have the big giants for the energy sector, Exxon and Chevron. So this is the most important week of earnings so far because it has a diverse list of names. Inflationary names, de-inflationary names, cyclical names, reopening names, tech names, high multiple names, and therefore we will have a clear outlook of where the market is heading next from the reaction of these earnings. Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow.